So what do you make of this 2-week time frame that the president has put out here to make his decision when it comes to Iran? How does that impact the markets? Does it impact certain sectors more than others?
Yeah, I think the thing that's been notable at this entire conflict so far is it really hasn't been seen as impacting the overall macro story for the US, for the US economy. It's been more focused on the energy commodities and then by extrapolation on the companies that develop energy in the US. So I think that the 2-week pause, we've seen these pauses turn into longer pauses when it comes to the tariffs, even when it comes to things like TikTok. So I think the markets are seeing this as a welcome kind of reprieve from the very kind of high tension environment we've been in. We've seen a little bit of a decline in oil prices in some parts of the world. I think you could continue to see kind of a wait and see approach first by the equity markets and also by the commodity markets. It's been interesting. You haven't seen much of a move in interest rates and the dollar, and that's been true really since this started. The dollar was not seen as like a big boost, a big recipient of safe haven assets, and neither has the treasury market. That may be because of everything else going on with the U.S. assets, but it may also be because this conflict just wasn't seen as rising to the level of something that was going to affect the U.S. economic outlook.
You know, to that point, you're talking about the commodity market. So we have seen oil move higher. We just highlighted that a minute ago. But actually, week to date, gold is down, which seems a bit counterintuitive. That seems to be the ultimate safe haven. Why do you think investors have moved away from gold but have put money into the U.S. dollar? We're going to talk about the dollar just a bit later in the show, but I just want to get your take.
The gold price moved up so quickly in the first quarter, and it's really been flattish. It's been choppy, but flattish in the second quarter, which has been interesting given everything that's been going on. U.S. TIPS, Treasury, inflation protected securities have had a similar kind of pattern, often very correlated with gold. I think one of the reasons you've seen this handoff, and it hasn't been a huge rally in the dollar since the conflict started in the Middle East, but to this point, a lot of the risk in 2025 has been oriented around the U.S. itself. And so we've seen money move out of dollars, to your point earlier at the top of the show, and into other currencies, including things like gold. Right now, when it seems like that it's more the world's at the riskier place, right? There's things happening outside of the United States that may be causing people to pull money out of other assets and move back into dollars. But again, the move just hasn't been huge. Gold's off a little bit, flat quarter to date, but still holding those very, very high levels it achieved from the rally in the first part of the year.
You know, Brian, I want to go back to that Fed meeting, and there's so much going on. We're getting to the Fed meeting at this point in the conversation, when normally that's probably where we start. So the Fed signaled potentially 2 rate cuts later this year, but also Jay Powell saying that he's expecting to see an acceleration of inflation due to tariffs and also slower growth, which is stagflation. You believe if it weren't for the tariffs, the Fed would already be cutting right now. But with the idea that we could potentially see stagflation, how does that impact some of the most tariff and consumer sensitive sectors? I'm thinking discretionary, staples, and retail. If you look since April the 2nd, interesting enough, discretionary and retail are actually outperforming the market and staples are lower. Generally, I think of staples being able to pass along those price increases and the other two sectors not being able to do that.
Yeah, there's been so much noise and so much chop in the tariff story since the start of this quarter, which really coincided with Liberation Day. That the quarter to date numbers I think can be misleading in terms of what's actually been going on at various points. So to your point, like technology is the best performing sector this quarter. We probably wouldn't have guessed that 3 months ago or so. The big takeaway from the Fed meeting was the forecast changes were, as you point out, in that stagflationary direction. So the Fed now thinks the GDP growth this year is going to be 1.4%. That's right on where consensus is. And that's a weak number. And at the same time, they revised up their inflation forecast for both this year and next year. That puts the Fed itself in a very tough position, and the markets as well. If you're an equity market investor, you want to see higher growth, you want to see lower inflation. Getting the opposite of both of those things, again, bad for margins. And when you combine it with the rise in the oil price, assuming that sustains to some extent, and also the tariffs, it creates just a ton of uncertainty about how companies are going to be able to make money in the second half of the year. And remember, underlying all of this is weaker U.S. consumers, weaker U.S. labor market, not to an alarming degree, but we've been pointing out all year that even without the noise from the tariffs, without the noise from the oil price, you are seeing incrementally weaker U.S. economic data, and that's not a pleasant surprise for equities either.